Hi everyone. Welcome to Level Up Dividends channel. Operating margin is the percentage of revenue that a company keeps as operating profit. This is a significant indicator since it informs investors about a company's profitability and provides an easy way to compare other businesses or industries. If the company has a steady and substantial margin, it means it has the ability to thrive and most of all the ability to pay and even raise its dividends across the years. I always talk about dividend safety in my videos. One of the main metrics that help assess the safety of a dividend is the operating margin. So make sure to look at it before you invest in any company. Today I'm presenting 10 stocks that have an operating margin well above 20%. Of course these stocks pay dividends. I only present stocks that pay dividends in my channel. Now let's get into it. The first stock I would like to feature is the very known Microsoft. Even though the stock doesn't yield that much, around 0.72%, its capability of paying the dividend is considered very safe. Besides, Microsoft has been increasing this dividend by a whopping 19% per year for the last 20 years. The company is very likely to increase it in the coming years, and why not, since the company has an outstanding margin of around 45% today. This margin has been increasing steadily for many years and is poised to thrive. The free cash flow, which is a good indicator of the financial situation of the company, is around 30% too. This cash allows the company to make acquisitions, invest in the R&D, or make returns to the shareholders. For me, Microsoft is a must-have for every serious investor. Note that 31 analysts recommend to buy the stock. With a price target of $470, Microsoft has still room to grow. But for me, the stock price is getting even higher in the upcoming years. Guys, if you invested $1,000 in this stock 10 years, you would now have $12,000, that 12x your money in just 10 years. Don't believe it's too late to reiterate this. The second stock I would like to talk about is Visa. Like Microsoft, Visa stock doesn't yield much, only 0.73%. However, the dividend payments are considered very safe. Besides, the company increases this dividend by 18% per year in the last 10 years. The dividend growth streak of the stock is 15 years. Please notice that only the dividend yield is considered somehow low, but the overall return of Visa stock has been huge for the last couple of years. Beware that the dividend yield itself without looking at other metrics doesn't mean the stock is of good quality and that you're going to make much money out of it. Indeed, if you invested $1,000 in Visa stock 10 years ago, you would now have more than $5,000. So you would have 5x your money with a stock that yield only 0.7% today. See the trick? The operating margin of Visa is something beyond imagination. We're talking about a margin of more than 60%. I don't know many companies that have this profitability. 22 analysts recommend the stock. With a price target of $307, its price potential is 7% higher than its current price. Stock 3, KLA Corporation. The dividend yield of the company is 1.04%. Its dividend safety score is 71. KLA has been increasing its dividends by 16% per year in the last 5 years. In the last 10 years, it is a 13% increase per year. The company has been increasing its dividends for 18 years. The operating margin of KLA has been steady and even increasing for the last 10 years. With a 37% margin, a payout ratio of only 22%, the dividend seems secure and poised to grow rapidly. 8 analysts recommend to buy the stock and 4 to hold it. The stock price seems to be around its intrinsic value. Stock 4, Home Depot. The dividend yield of Home Depot is 2.41%. Dividend safety, 87. The company has been growing its dividend by 19% per year in the last 20 years, which is pretty awesome. Dividend growth streak, 36 years. The company has always had an operating margin above 10%. Its free cash flow is around 12%. Good metrics. 17 analysts rate this stock as a buy and 7 to hold it. The consensus seems clear. I really like Home Depot. You should have a closer look at it. The fifth stock I would like to highlight is Microchip Technology Incorporated. The dividend yield of the company is 2.05% and its dividend payments are safe. The company has been increasing its dividends by 12% per year in the last 5 years. In the last 20 years, it is a whopping 23% increase per year. This is crazy. The company has been increasing its dividends for 20 years. The operating margin of Microchip has been increasing steeply for the last couple of years. With a 39% margin, a payout ratio of only 23%, the dividend seems secure and the future bright for the company. 11 analysts recommend to buy the stock and 5 to hold it. The price target of the stock is 3% higher than what it is today. I can't make this video without mentioning Broadcom, my major position in my portfolio. Dividend yield, 1.92%. Dividend safety, 67. Dividend growth, 19% per year in the last 5 years. Dividend growth streak, 13 years. The operating margin is something from another planet. We're talking about 46% margin. What better metric can make feel comfortable about this stock? My 7th stock is Universal Display. Dividend yield, 0.79%. Dividend safety, 70. Dividend growth, 58% per year in the last 5 years. Dividend growth streak, 5 years. Except 2015 and 2018, the operating margin of the company has always been above the 20% mark. The company seems somehow overvalued right now. Still, if you're looking for a growing dividend income, you can still grab some shares. The 31% payout ratio allows for greater room for the dividend to grow. Have a closer look at Universal Display. With a price target of $199, analysts forecast a 24% for the stock. Stock 8, NXP Semiconductors. Dividend yield, 1.93%. Dividend safety, 60. Dividend growth, 20% per year in the last 5 years. Dividend growth streak, 4 years. NXP's margin has been above 20% for the last 3 years. This chip stock is down 7.8% year to date as of January 9, but analysts aren't concerned. Analysts forecast a 7.6% price appreciation. Coupled with the dividend growth, NXP Semiconductors could be a good investment. NXP, situated in the Netherlands, may potentially have an advantage due to its extensive experience in the electric car charging business, which is a specialty of the chipmaker. Currently, NXP appears to be the most consistent charging component in the green vehicle market, but it has also hedged its bets. NXP stock also benefits from strong demand in the smartphone sector, as the company manufactures a chip that helps cell phones with mobile payments, among other functions. My 9th stock of the list is Qualcomm. Dividend yield, 2.31%. Dividend safety, 80. Dividend growth, 5% per year in the last 5 years. If we take a look at the last 20 years, this rate is of 20% per year, which is outstanding. Dividend growth streak, 20 years. The margin of the company is not growing, maybe because of the fiercer competition. Still, it has been around 20% or slightly above during the last couple of years. Still honorable. The company also benefits from its status as one of the world's largest wireless device manufacturers, and its processors are used by nearly every major handset manufacturer in the industry. A lot of analysts cover this stock. 15 recommend to buy at a price target of $164. With APE ratio of 15 lower than its peers, Qualcomm looks interesting to buy at today's level. With a 2.3% projected dividend yield, there's strong incentive to bet on QCOM into 2024. Stock 10, Zoetis. Dividend yield, 1.01%. Dividend safety, 74. Dividend growth, 23% per year in the last 10 years. Outstanding record. Dividend growth streak, 10 years. Zoetis has an operating margin well above 30%, and I'm pretty sure this margin will continue to grow. The company is one of the leaders of the animal healthcare, if not the leader. With pets getting more and more attention and becoming family members of more and more families across the globe, Zoetis will certainly profit from this and expand its margin even further. Analysts recommend to buy the stock. Zoetis could reach $226, which is an upside potential of 32%. This is it. Tell me in the comments if you own some of the stocks I highlighted or if you know other stocks that have substantial margins. I would be happy to read. Remember, I am not a financial advisor. Don't forget to make your own due diligence before investing. Please push the like button if you like the video and subscribe to the channel for similar content. I'll see you next time.